everyone. Welcome to another episode of Ready to Scale. I'm Ellie Perlman, the founder and CEO of Blue Lake Capital. Today, I want to talk to you about the fact that the real estate market has just reset. And I want to look into the data and share with you how I'm seeing the market and the data and what the data is exactly telling us. Forget about the headlines. Every day, I see another article about the state of real estate, whether it's the time to buy, not time to buy. There's another asset that has been returned to the bank, etc. So everyone has an opinion, but I've noticed that many investors and many people don't actually look at the hard data and they're getting their main information from articles, opinions, etc. So today I'm going to show you six numbers. That's it. Six data points that will tell you exactly where we are in the cycle and why this moment matters and where the smart money is and what it does right now. And I've been doing this for over a decade. I've underwritten over $1 billion in multifamily, assets. And I can tell you now that the data is telling us a very clear story. You just have to know where to look. So let's get started. So the first data point is replacement cost versus acquisitions cost. That's the most important number in real estate right now. And I can tell you that institutions and large operators, large real estate investors are essentially looking at that as the main thing. They used to be more focused on IRR, and some of them used to look at yield on cost, which is also big today. But now the first thing that every investor is looking at is price per door. And they essentially compare the price per door, which is acquisition cost, to replacement cost. And so replacement cost is what it actually costs to build a new apartment building today. And replacement cost is comprised of a few items. One of them is, of course, the land. So, for instance, in many markets in the Sun-Belt suburb, it can be anywhere from 30 to 50, 60,000 per unit. In urban cores, it can be $60,000 and higher. Now, that's just the land, of course. To that, you add hard costs. So usually it costs 180 to $220,000 to build each unit, which essentially these are the concrete, the steel, lumber, labor, HVAC, the plumbing, everything that goes into building, actual building an apartment building. And then you add to that soft costs. So all the permitting, engineering, architecture, insurance, legal, all that good stuff. Soft cost is about 20 to 30,000 extra per unit. And of course, the developer they do not volunteer. There's a profit that goes with it. So the profit margin is about 10-15% of total cost. So if you sum all these items, all these parts of building an apartment building, the total cost is between 250 to 300,000 per unit. I would say that many times it's closer to $250,000 a unit in the markets that we're looking at, which is more suburban locations. And there are markets where it costs a little bit more, a little bit less, but 250, 260, that's the main number that we are looking at as a basis for replacement cost. Now, when you look at Class B apartments, which is many time garden style, it's in good condition, it attracts the right type of tenant, but it's a little bit older. Those are trading between 180,000 to 200,000 per unit today. It did not used to be the case 6 months, a year, 18 months ago, but now these are the prices. So that gives us 20 to 40% discount to what it would have cost to build those exact apartment buildings in today's market. So this really matters because this is a margin of safety. And I'm borrowing this from Warren Buffett and Benjamin Graham, and the idea is that you buy in at enough of a discount price that even if your thesis is practically wrong, you're still protected because the delta is so big that it's protecting you. And that's the margin of safety. So if you buy at 160,000 a unit, for instance, and replacement cost is 280 a unit, then you have $120,000 in cushion per unit. So values have to fall, another 40, 45% before you're in real trouble. That's a good safety margin. Um, and so if we compare it to the stock market right now, the S&P 500 is near all-time high with elevated, PE ratios. A 20% correction wipes out over 3 years of gains. So the margin of safety does not exist, or it's very minimal. So when you compare it to buying apartments back in 2021, which was at the peak, which of course you only know that you're at the peak when you're looking back, you'd never understand it where you're in it. People were paying, very high amounts per unit. It was sometimes over $250,000 a door. And many times the margin was 10%, 5%, which is not enough. So when interest rates spiked, that cushion was wiped out almost immediately because there was not enough cushion to cover for any market corrections. So in today's market where we find deals because the market has reset at 30, 40% discount, that's a wide margin of safety. And, back in 2010, 2012, after the financial crisis, apartment values bottomed and nobody wanted to buy real estate. And of course, the headlines were apocalyptic. But Class B apartments in Dallas, they were trading at a very low price that we don't even see today. And you could have bought assets at below $100,000 a door. Replacement costs were $120,000, $150,000 a door. So at that point, you could have bought apartments at 40 to 50% discount. So everyone who bought between 2010, 2012 made a lot of money because they had a wide margin of safety. And of course, Sam Zell, which is arguably he was the greatest real estate investor of all times. He was known for making his fortune buying during periods of maximum fear. And he always said the definition of an entrepreneur is someone who will go where nobody else will go. And I'm not saying the values will double from here, but the setup, the prices are below replacement cost, where you have distressed seller, and also there's capital on the sidelines. That's very, very similar to what happened back then. And so the gap exists right now because sellers are under a lot of pressure. Many of them took loans with adjustable rate and they bought a cap, which essentially is a ceiling to how much interest rate they would pay, but they usually bought it for 2 to 3 years. And the loans were given for 5 years. And so after 2 to 3 years, it was very hard to buy another cap because either they ran out of money or the costs have gone up tremendously. And at that point, they had no choice but to sell the asset. And they're selling it where, because they have no choice, they have to sell it at a very, very bad timing where valuations are actually down. And that's why you also see this gap in terms of when it comes to replacement cost and acquisitions cost. In that case, for them, the math can be really brutal. If you're taking $30 million loan at a 3.5% interest rate, which was the interest rate back in 2021, let's give or take $105,000, $106,000 a month in payment. Now, once the cap expires and they don't replace it, now interest rate is 7.5%. That's over $200,000 a month, which means that you have about $100,000 or more in debt payment every month, which is 1.25 million a year. So that actually wipes out the entire cash flow. And construction costs, on the other hand, haven't come down. We all know that there's labor shortage. We all know that materialize because of the tariffs, etc. Materials have gone up significantly, and insurance, of course, has also gone up. So many developers cannot build apartments right now because it just doesn't make economic sense. So if you take all of that together, you take the fact that developers don't build anymore and sellers have to sell, we have a widening gap between acquisitions cost and replacement cost. So motivated sellers that have to pay to sell because they have pressure from the lender and they have to exit right now, um, that is happening. And if you add to it the high build costs that prevents new competition, then you really have the widest buying window in a decade. You're going to buy at a really good basis, and even if there's a little bit more new apartments that would compete with yours, that is going to be disappearing in a very short period of time. And I'm assuming probably 12 to 18 months because those apartments will get filled. And once they're occupied and stabilized, they're not going to offer more concessions and they're going to stop competing with other older assets. So this window right now that we're in, that's not going to last much longer. There's many institutions that are still sitting on the sidelines. There's over $250 billion in real estate funds. And there was a very big fund that just recently raised about 5 billion in over 5 billion in distressed real estate. They're going to start deploying next year, maybe even this year. So the more capital chases deals, it's very simple math, and we've been there before. The more capital chases deals, discounted prices, the more prices will rise, and that window is going to narrow. So it's a great window. We haven't seen it in a decade or more, but it's not going to stay open forever. Okay, now let's move to the second data point, which is the construction cliff. The supply wave everyone is worried about is real. There is oversupply. There's no doubt about it. But it's a short-term story. This is not the full picture. And so, for instance, there's 45,000 apartment units that have been delivered or they're under construction right now. So the market absorbed about 15,000 units a year. And that's 3 years of supply sitting at once, but will be absorbed eventually. Rents are flat, um, and concessions are, 1 to 2 months for free, and it's pretty common. But that's, for instance, kind of a snapshot of what's happening in one market. Let's look at Nashville, for instance, 25,000 units in a pipeline for a market that absorbs about 10,000 a year. So you have very similar dynamic. You have rent pressure, but it's in near term, in a short term, because eventually over the next 1, 2, 3 years, all these units will be absorbed. These are two examples. On the other hand, if you look at Phoenix, supply is really concentrated in the Scottsdale, Tempe corridors, but there are other pockets like Mesa and Chandler and Gilbert where there's actually under supply and there's rent growth that we're seeing there. So that's a nuance that many people miss when they think the Sun Belt is oversupplied. Yes, in some pockets it's definitely true, but it's too broad. You need to look at the specifics for a submarket and a pocket that and make up your own decision. So you can drive 5 miles north and you're in a very different market. So this is why operators that actually know the sub-market intimately, they will have a massive advantage because they're going to make a move and buy where everyone else who does not know the market as well are going to shy away. They're going to make a move against fear based on hard data, and they're going to essentially buy assets at a discount. And when everyone else is going to be comfortable in a couple of years, there's always a premium that you pay for comfort. This is not just for real estate. And this concept is, but it's essentially specifically true for real estate. So by the time everyone else is going to be comfortable, meaning all the new construction is going to be absorbed, then those buyers who are now on the sidelines will pay a premium. And essentially, those who make the move now, may have a short-term pain, not in all markets, in some of them, but they know what they're getting into. They can underwrite it, and then they're waiting for the valuations to increase as the market absorbs more units. So there's a data point that almost nobody's talking about, which is really that the new construction has fallen off a cliff. When we're looking at new starts and new permits, and the data is there because it's public, we see a tremendous decrease in new permits compared to the peak of 2021. And at some point it was 70% decrease. And that tells us a story that even though there's a certain pipeline, it's going to be absorbed, it's going down, and there's nothing much behind it. Meaning there's no new units that will compete with current apartments. And then everyone is going to start raising their rents. So this is a very important part to understand that those who read the data and not act out of fear, act based on hard data and they're patient, they're buying at the right time. Because in real estate, you never buy low when everything else is hunky-dory, right? That's the story of real estate. That's why it's cyclical. So um, it's very important to understand those points of data. So let's put some numbers, right? In context, so you have a better understanding. So multifamily building permits nationally are down about 40-50% from 2022. And the number, as I mentioned before, is even higher when you compared it to 2021. In some markets, like DFW, it's down 55%. The actual construction starts, which are new units being built, 550,000 units. That's the number. 550,000 units started to be built, to be constructed nationally in 2022. And in 2024, it went down almost half to 280,000. And by the end of 2026, it's going to be even lower than that. So we see that 50-60% decline over 3 years, and that trend is continuing. And we talked about why developers stop building. It does not make economic sense. I personally know developers that either closed up shop or transitioned to other verticals of real estate, and they're not developing new apartment buildings. It just doesn't make economic sense. And so the timeline math tells us exactly what's coming. So, like I mentioned before, you have permits that are going down. The number is going down every year. And from permits to stabilize property, it takes about 3 to 4 years. And everything delivering in 2025 that has delivered in 2025 and will deliver by the end of this year, 2026, that started at the peak of 2022, 2023, when financing was still available, costs were still low to build, and developers were still optimistic. But that changed. So almost everything about it changed. So there was almost no new construction permits that were submitted between 2024 and 2025, and until today, actually. Permits, they actually tell a very powerful story that the pipeline is empty. No more new units are coming online after those that are already in the pipeline and started the process. And so we're really looking at a fraction of the peak. We're not talking about 500, 200, or even 100,000 units. It's a much, much smaller number. And so this is something that I want everyone to understand. If you're listening, to understand that there's fear, but around oversupply. And of course, when we're looking at an asset to buy, we're checking within 3 5 mile radius how many units are coming online in the next 5 years that we're going to hold the asset. And we choose to buy assets that have essentially zero or very few units coming online, very few projects coming online. So we don't have that competition. But those with a lot of competition will actually be sold at a much higher discount, much steeper discount. And once all that is being absorbed, that's where you're going to capture the real value. So when you're buying now, and this is what I want you to take away from this, what it means for investors that are buying now is that the first couple of years in the markets that have strong supply, there will be some pressure on rent growth, meaning you cannot expect to have 3, 4% rent growth. It can be moderate 0 to 2%. Then in year 3 to 5, to your hold, supply dried up, and this is where you can expect seeing rents growing because when new apartments are being delivered, they're 0% occupied, right? The developer has a timeline and they need to return the loan that they took. And it's a very usually a very expensive loan. So they're in a race against the clock. They're trying to fill up the units as fast as they can so they can sell it. Because selling a brand new building with 0% occupancy is worth a lot less than selling a brand new building with 50 or 70 or 90% occupancy. How do you ramp up and scale and essentially fill up the units fast? You offer concessions. You offer 1, 2 months for free. You offer discounted rates, whatever you can, just to get people in the door, just to get them to sign on the lease, just to get cash in the door. You increase the valuation of the asset, and you can go in and out within several months. You can sell the asset, make your profit, if there's any for developers, and move on to the next project. But once you hit that 90%, 80% occupancy, now you have enough cash to pay the debt. Maybe you even sold it to someone else. And now is the right time to essentially raise rents, cut or eliminate your concessions, and maximize the amount that you can get per door. And that's exactly what has been happening. I've seen it before, and that's what's happening right now. And that's why in year 3 to 5, we can expect nationally to see rents increase. By that time, many developers are going to start the process, which because they're going to see all the rent growth, that's going to be very enticing. Of course, assuming the debt is going to be reasonable, and they're going to start a process of submitting new permits. That's going to take another 3 years or so. So you see that's a cycle. But at that point, many other investors will be also interested in buying because the fear is going to be gone. They're going to see rent growth. Everything's going to underwrite really well. But then they're not going to be able to buy an apartment building at 150 to 200,000 a door. It will be a lot more expensive. And that's why it's a very, very interesting period to buy real estate. Now, the third data point is the cap rate spread. And this is a very important one to understand. So when we're talking about cap rate spread, this is the number that essentially tells you whether real estate is cheap or expensive relative to other investments. So the cap rate, of course, and many of you that listen are very sophisticated investors, and you know that already. But for those who are just starting to invest, who may not know that, cap rate is the property's net operating income, so NOI divided by the value. So property that is making $1 million, say $1 million a year in NOI, is valued at 20 million if market is at a 5% cap rate. So this is kind of the yield on real estate. And then we have the 10-year treasury yield, which is the risk-free rate. What you could earn lending money to the US government with absolutely, no risk, zero risk. So the cap rate spread is the cap rate minus the treasury yield. And this is the premium that you earn for the willingness, the ability to actually take a risk of owning an apartment building instead of just buying government bonds. So historical average spread was 150 to 200 basis points. So it's 1.5 to 2%. That means that real estate typically offers 1.5 to 2% more yield than risk-free bonds. And the premium compensation compensates you for illiquidity, for taking the risk, and for essentially buying real estate. And in 2021, something very interesting happened. Multifamily cap rates were 3, maybe 4% in some markets. And at that point, where people were buying assets at 3 to 4% cap rates, the 10-year treasury was 1.5%. So the spread was essentially 200 to 250 basis points, which all in all, compared to the other 150 to 200 spread that we talked about earlier, that seemed normal. But a very low cap rate at 3 to 4%, that's unsustainably low in absolute terms. So you were earning 3.5% on a risky asset, and that only makes sense if rates stay at historic low forever, but they didn't. And that was an issue. So when the 10-year essentially spiked to 4.5+% in 2023, cap rates had to rise too. And nobody will accept 3.5, 3% from a risky apartment building when they can get 4.5% from a risk-free treasury bond. It just doesn't make sense, right? But when cap rates essentially increased from 3 to all the way to 5.5%, value just fell a tremendous amount. And if we're going back to the same example, when you have $1 million in NOI divided by, let's say, 3.5% cap rate, that's almost 29 million. So if you take the same NOI and we divide it by 5.5 cap on the other hand, then we're only getting to 18 million. So that's a $10 million loss. Same NOI, same asset, same location, just because the cap rate moved and the valuations moved. So this is just the impact of cap rate expansion. Not because the property got worse, the location got worse, everything else is the same. So right now, multifamily cap rates are between 5 and 5.5% in the markets that we're active in the Sun Belt region. Some markets are higher than that. Some assets are maybe older assets go all the way to 6%. Now the 10-year treasury is about 4.5 to 4, about 4.2, 4.5%. So the spread is 130 to 180 basis points. Of course, it depends on the exact market. So the spread is still a bit compressed if you compare it to long-term average. But here's the key thing. You're buying at a 5 to 6% yield in absolute terms. So that's a meaningful return that, even if nothing else changes, that's pretty significant. That's a big delta. So compared to 2021, when you were buying at 3.5 cap and you expected rates to stay or prayed for rates to stay lower for longer, today, even if the treasury set at 4.5%, you're still earning about 1% premium. And you're getting all the benefits of real estate, which is appreciation, all the tax advantage, um, etc. So if treasuries come down, which could be if there's any rate cuts or any economic slowdown, then cap rates can compress, and that would lead to real estate values to go up on top of course, cash flow. And this is the upside scenario that was just not reasonable in 2021. So, and I know there's a lot of numbers and a lot of comparison here, but just follow my logic here for a second. Let's take an example. If we buy a property that makes the same property that we talked about earlier makes $1 million in NOI a year. At a 6% cap, we're talking about 16.7 million in value. Now, over 3 to 5 years, the value increased because you grew NOI to 1.2 million. Let's say you renovated some units and you pushed rents. And in addition to that, so not only you grew it from 1 million to 1.2 million in NOI, in net operating income, the cap rates compressed from 6%, let's say, to 5.25%. And I'm assuming that there will be a movement in that direction because institutional capital is getting ready to be deployed. You have more money chasing deals, prices just go up. It's supply and demand. So the new value now is a higher NOI of 1.2 million divided by 5.25 cap versus the 6 that we had earlier. That's almost 23 million in value. The value earlier was 16.7. So we're talking about 6 million increase, which is 37% increase in value. But you got it from both pushing the income, pushing NOI, and cap rate compression. So this is kind of a dual engine that I do expect to see in the next 5 years as more institutional money coming is going to come back to the market, and as new construction, new starts are going to be and deliveries are going to be absorbed, and rents will increase and NOI will increase accordingly. And so we're going to see that dual engine. And this is how multifamily investors can generate pretty high returns. And it happened before in another cycle, and it can happen again. So the bottom line is that, risk reward is asymmetric. You have limited downside, you had significant upside, but if you're buying below replacement cost, like I mentioned earlier, and you have a wide enough spread, then you have multiple layers of protection. And essentially, when you compare it to 2021, the downside was enormous because the margins were too thin. So when we're looking at where we headed, where there are going to be many reasons for the movement, the compression of cap rates, in addition to increase in rents, increase in NOI, this is essentially why I think the spreads in cap rates are going to impact valuations in a significant way. Okay, so the fourth data point is insurance, and insurance can be really the silent killer. I'm not going to spend a lot of time on it. I think it's pretty self-explanatory, but something that is important for you to understand and know is that insurance has a tremendous impact on real estate. And so national average has increased when it comes to insurance premiums. It went up over 50% since 2021. Um, and, in Florida and some other markets, even higher than that. And there's a reason why insurance has been spiking in the recent years, and it's probably not going to come back to where it was in 2018, 2019. So first of all, we have, in terms of the climate, from 2017 to 2023, we had the costliest stretch of natural disaster in the US history. We had Hurricane Harvey and Irma and Michael and Ian, all those type of hurricanes. And we had a record hail season in Texas and wildfires in California that unfortunately also impacted my own house over a year ago. And the carriers, they just had to pay billions of dollars to cover all those losses, and some of them exited some markets. And that just increased the premium for everyone else. And so when it comes to valuations, every dollar increase in NOI and expense in NOI or decrease in NOI because expenses go up, every dollar has a tremendous impact on an asset. And when insurance increases in a significant amount, that can really hurt the asset's valuation. And of course, if once the company an owner puts an asset in the market, what really happens is that buyers are looking at income and they're pegging the income to how much the current ownership was able to get, and they would increase it only if they're convinced that because of absorption of new construction, there will be an increase in market rates, or if they would be able to push rents because they are going to implement a value add plan and renovate units, etc. But when it comes to expenses, they have their own metrics, and they many times disregard most of the expense side when they're looking at financials from an asset that they're looking to purchase. So it's possible that if we're buying an asset from a smaller operator, we know that our insurance prices, our premiums are lower because we have a a discount based on the number of units that we own, and we can underwrite it differently. But the opposite scenario can also be true. If you're looking at an asset that is purchased by Blackstone, but the company that buys it is smaller than Blackstone, which is many companies, they don't necessarily have the ability to compete on insurance because Blackstone can get better terms under their umbrella insurance. That was just an example. And so that's something that investors should be aware of to ask essentially, what did you do to get to the insurance assumptions? And I can tell you that we never make our own assumptions. Everything is coming as a quote from very experienced consultants in the market with with tens of years of experience, and that is something that can really impact an investment. And so have to understand that insurance is a big data point, and that's data point number five. So we have two more to go. Okay, now let's move to the fifth data point, which is the migration. You got to follow the people. This is actually the most powerful long-term fundamentals in apartment investing, and it's very simple, right? So the more people that move in, the more demand is for housing, the more hands knocking on doors, which also translates into higher rents. Higher rents equals higher property values. So let's take a few examples. And in Texas, for instance, we had over 470,000 net new residents in the most recent data that we have from the census. In Florida, that's 365,000. And in addition, you have markets like Georgia, North Carolina, South Carolina. All these markets are attracting a lot of new tenants. The losers, New York, they lost about 130,000 people. California lost 340,000 people. Illinois, lost about 100,000. And this is a 5-year accelerating trend. It's not a one-time occurrence. And this is happening because the markets that I've mentioned, they have low or no state income tax. They have lower cost of living, so people can actually, with $500,000, with $250,000, they can buy a house. And where they come from, that's not enough for the life that they want for themselves and their families. And these were major drivers, and I personally think that Florida and Texas are the biggest winners when it comes to population, to immigration within the US. When I say Texas, it's again, you need to look at the corridors, at the submarkets. Austin has very strong migration, but it's massively, massively oversupplied. And so this is actually putting a lot of pressure on rents. So Austin should be looked at very carefully. But Dallas, on the other hand, Dallas's population keeps growing. There is a pretty, I would say, a pretty large number of units that are being delivered, but absorption is very good. And that's why we actually starting to see a steady increase in rents in units that we own in the Dallas market. And so there are kind of three variables that I'm looking at. First of all, of course, like I mentioned, it's net migration rate. The more people move in, the higher the demand. That's pretty simple math. The second variable is job diversification. And that's what I've been always saying about Houston, which I know it still attracts people, but it's very energy dependent. It's too concentrated around energy, and that's a big risk because if the market shifts and many times it has impacted the energy sector, then many of your tenants are going to lose their jobs and your cash flow is going to be impacted. So diversification is very important. Orlando is a great example for a pretty diverse market. Dallas, of course, and other markets. Now, the third variable is the supply pipeline as a percentage of existing inventory. So if you have high migration and you have low supply, that's pricing power. You know rents are going to go up. When you have high migration and high supply, it could be a wash. So you got to find a sweet spot. Of course, high migration and low supply is the golden standard and what you're aiming for. Right now, you have many markets with very high, very solid migration and supply that might not be low, but might not be extremely high, where you can still see rents stabilized or starting to go up. And so that is a very, very important variable to look at. And markets that score best on all three, Dallas, for instance, DFW suburbs, like Frisco, McKinney, great submarkets. Even in Atlanta, you have Gwinnett and Cobb that are very, very strong markets. And so these are the markets that I want to focus on. And I'm avoiding those who essentially score, maybe well on migration, but they fail when it comes to supply, like Austin, like I mentioned before. So that's the fifth data point. Okay, our last data point number six, is the debt maturity wall. There's about 900 billion in commercial real estate loans that is maturing between 2024 and 2026. Now, about 35 to 40% of it is multifamily. It's not 100% multifamily, but this is an enormous amount of debt that is coming due. And a lot of those cannot be refinanced. And it's a real problem. So those who borrowed that took a loan at 3 to 4% interest rate, now they need to refinance at 6 to 7%, maybe 5%. And the math is simply devastating. And so what happened is essentially when an asset was purchased, it was purchased based on a very low interest rate. And LTVs could have been 70, 75%, sometimes even more. So what happens today that makes a lot of those loans not qualified to be refinanced? First of all, lenders, when they look at a loan, let's say someone took, a company took a 3-year loan, a 5-year loan, and it's coming due right now. A new lender is looking at it, and ideally, if it's not the right time to sell, like I've mentioned before, because valuations are down, many owners say, okay, we will refinance and put new debt and repay the old debt and get another 3 to 5 years. And then when the market shifts, then we are in a much better position to sell. But here's what happens. There's a DSCR test. So lenders, they require the NOI to be at least 1.25x of the debt service payments because they want to make sure that there's a cushion there to pay the debt. So at a higher interest rates, because we're not talking about 3 or 4% anymore, and rates today go between 4.6, I've seen the lowest one, all the way to 5.5%, but it's still much higher than 3 to 4% that we've seen in 2021. So higher rates, at that higher rate, many properties they fail that test because there's not enough NOI. It doesn't hit 1.25x to pay the higher interest rate. So they don't qualify for a new loan. And so the borrower can either pay down the loan to lower the essentially the principal so they can fit into the 1.25 DSCR test and pass it, but that is usually 8 to $10 million. Or they can inject new equity if they call capital from their own investors, or they can sell the asset, which is absolutely the worst time to do that. So let's look at the historical parallel because this is actually pretty fascinating. So right after 2008, Lehman Brothers went bankrupt and the banks were forced to liquidate billions of real estate loans, and they sold assets at 40, 50 cents on a dollar. Blackstone at that point raised about 13 billion. That was 2012. They raised it for their largest ever real estate fund, and they deployed it by buying distressed apartment buildings, um, I'm pretty sure it was the largest apartment portfolio in the world, and that fund returned over 2x in returns to its investors. So the playbook was simple. You buy good assets from distressed owners. Many times it's because the debt structure is not conducive, and the building or the location didn't get worse. The same tenants, same location, maybe even similar NOI, but the debt is and the valuation, how much you paid for it, that actually changed everything. So today the situation is pretty much similar, maybe in a smaller scale, but this is not a systematic banking crisis. The properties are fine. Some of them are okay. Yes, there's some pockets that essentially suffer from in elevated bad debt, but the tenants are usually the same. And the main issue in many, many of those deals is the debt structure. So those deals are being made quickly. Many of them are off market. I get, calls from some of my friends in the industry that want to offload those assets. They don't take it to market. Many times, either you buy it from the operator, the owner, because they're trying to avoid bankruptcy, or you buy the note directly from the lender. And many, many times, those distressed assets don't even hit the market. They're all off market. So this is the lesson for today, that the assets, many times the asset didn't fail, the capital structure failed. And so some buildings, the same tenants, same area, if nothing really changed there, same market, only the only variable is the debt. Now that looks like a very interesting opportunity. And these are the opportunities that I personally like. So when I look at every deal, I'm, placing trying to place fixed rate debt as much as I can. And I'm trying to match it to if I want to own the asset for 5 years, I'm going to put 5-year loan, not 2-year loan, and then get caught like many other operators that got caught post 2021. And of course, you need to make sure that you have enough reserves for 6 to 12 months of debt service if you can. Deals don't always support that, but if you can, that's preferable. And essentially, this is the debt structure is something that we see a lot. And that's very important to understand whether the distress comes from man managing, mismanagement, or from the debt structure. It has nothing to do, it's got nothing to do with the actual management. But the debt decision in a single most consequential, it is the most, you know, the single most consequential decision in any real estate deal. And you have to make sure that you understand what the debt structure is. So those were my six numbers: replacement cost gap, construction cliff, the cap rate spread, insurance, migration, and debt maturities. So if you put them all together, they can tell you a very powerful story that the market has reset. Prices are below replacement cost and new supply is drying up in many, many markets, some more than others, but that is the general trend. You have a lot of distressed sellers that are creating buying opportunities, and the markets with the strongest fundamentals, which is Dallas, Atlanta, and the Carolinas, for instance, their demand far exceeds supply. So it doesn't mean that every deal is a good deal, obviously. It means that the setup is the best that it has been in decades. I can tell you that 2, 3 years ago, we were buying very slow because most deals did not pan out. And now pricing has reset and we find a lot more interesting deals that actually make sense. And it's pretty conservative. With pretty conservative underwriting, we can make we can make the deal work, and it really lowers the risk in a significant way. So your job and my job is to pick the right assets in the right markets with the right debt structure and essentially run it in the right way. So if you want to talk about this more, you can reach out. I love talking about this stuff. I'm passionate about real estate and multifamily specifically. And if you find this valuable, share it with someone who is sitting on the sidelines because, they're scared. So they understand what the data is really telling us right now. And data is essentially very solid and it's telling us a very, very clear story. The market has reset it's a very interesting and probably the best time to buy real estate. Until next time, I hope that this was valuable to you, and I will see you on the next episode.